This is Unreal. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, the U.S. government is about to do the unthinkable, and what I want you to understand is we're making the exact same mistakes that plunged us into the last financial crisis. The only difference this time is that nobody thinks it can happen again. I'm going to show you what the experts think, what the media wants you to believe, why we're actually headed into another financial crisis, and then you're going to see why what the U.S. government is about to do is completely unreal. Now let's head over to Bloomberg, where we picked today's story up with a headline as Larry Summers, former Treasury Secretary, says a 50 basis point rate cut in September was a mistake. And this is what we're hearing now because of the non-farm payroll report that came out on Friday. Everybody thinks the Fed just made a huge mistake. But wait till I show you the truth of what's really going on in the economy and why we're making the same mistakes that sent us into the last financial crisis. With the benefit of hindsight, the 50 basis point cut in September was a mistake, though not one of great consequence. Non-farm payrolls increased 254,000 in September, the most in 6 months. Now, one of the dangerous things we've seen here is the Bureau of Labor Statistics. Their accuracy on the non-farm payroll report is terrible. And yet one of the issues that we continue to face is policy is being made based on this government data. We know the real number isn't 254,000. But that's what the headline printed, and that's what policymakers are looking at. The unemployment rate fell to 4.1%, and hourly earnings increased from 4% from a year ago. And of course, what we noted is there was one issue with the report that nobody wanted to bring up, and that was the fact that we see hours worked is stagnated, in some cases declining. That is a huge red flag for the economy. Just because you see, of course, wages rising, if hours worked are declining, it's a recipe for a recession. But we'll talk about why we're heading to a financial crisis in a little bit. Let's still look at what the experts are saying, because Summers says today's employment report confirms suspicions that we're in a high neutral rate environment where responsible monetary policy requires caution and rate cutting. Now, what does he mean by neutral rate? Well, there is this belief that the Federal Reserve can magically control the entire U.S. economy by simply raising and lowering the funds rate. And there's this belief that there is a neutral rate or a certain level that if you set the funds rate, the economy doesn't grow too fast, it doesn't slow down, it's just ideal. If you believe that, well, hang tight, because it doesn't exist. During the Fed September meeting, policymakers said they were confident that inflation is under control and shifted their concern to the labor market, and for good reason, because what do we continue to see in the survey data that's completely different than, of course, the non-farm payroll report? Is we hear from manufacturers, we hear from service providers that they're cutting employees, they're reducing the hours of work, they're not seeing a lot of new demand coming in for new orders to sustain the workforce, they're working through the backlogs. All these are red flags for the labor market. It's not just the U.S. We're seeing that in Europe. We're seeing that in Asia. It's happening all over the world. The latest jobs data is helping ease some of those worries and has investors betting on a smaller quarter-point cut at the Fed's November meeting. Now, prior to his non-farm payroll report, the belief is this report would come rather weak, and this would set up another 50 basis cut in the funds rate. Now it's being dialed back. So I want you to see the experts are saying here, wait a minute, based on this report, it looks like the economy is running really hot. But the truth is the labor market's about to come unwound. Let's talk about inflation, because the first concern is inflation coming down? The answer is absolutely. Has everything to do with the labor market. Let's take a look at the unemployment rate in red against the consumer price index in blue. That's shown on a year-over-year rate of change. And what you can see going back to the 1970s is, yes, you can get, of course, people hitting the unemployment line and inflation rising, but it doesn't last. You see, as more people get on unemployment, their spending power declines. What you see is inflation turns into disinflation, and that happens all throughout the 70s, even into the 80s. And as you get into the 90s, you see the relationship show up again. It's not until the 2000s where you actually see the two or more in sync. Then we get into the global financial crisis, where we see oil prices surge higher, drive inflation up, and then it comes crashing down into deflation. And here we're seeing the same trend in unemployment tell us that inflation's coming down. So that's not the issue anymore. The problem is the labor market is the risk here. But let's look at another expert, and we'll talk about what the media is up to, because Ed Yardeni sees Fed pausing the rate cuts for 2024 after the jobs report. And you're going to hear more and more experts come out and say, hey, the Fed made a mistake here. That's what Summers is saying. They didn't need to do the 50 basis point cut. But one thing I want you to understand is the Fed had no knowledge of that payroll report. So had they known it was 254,000, they probably wouldn't have cut 50 basis points. That was the issue. The Fed had no information. So the question is, had the Fed left rates alone or raised rates or done anything else, would it have changed the payroll report? The answer is no. I think the real reason the Fed actually cut here was to create some space for policymakers in other parts of the world, so throughout Asia and Europe, to cut their funds rate. I'd love to know what you think. Why do you think the Fed cut rates? Hit the comments below. Let's talk about what's going on with Yardeni, because again, he says, this market veteran says September's move was not necessary. Well, hindsight is 2020, but one thing we do see for your future is making money in the market. Let's talk about beating the machines. This is our CTA Timer Pro report. The way this works is we look at machine positioning every day. When they get deep short and price moves against them, that means machines have to short cover and put money into the market. That puts money into your pocket. Look at this. Our uranium trade hasn't been on the books for even a month, up 17%. And yes, it's that easy for you to make money. Look at this. Going into the weekend, 4 open trades, 100% win rate. Momentum Timer Pro. Maybe you like to trade the RSI and the MACD, but you get it wrong. Right now, we're hitting on a 50% win rate. We think that number is going to go up in the next week. We just added a trade for Monday, but how about this? You get the reports, the tradable signals. I go through every trade for you, tell you these are the ones I think you should do. We give you the full back test data, and here's the best part. Coming soon, we're going to have the hottest trades for a CTA Timer Pro identified, the ones that have greater than 50% probability of you making money. Nobody else backtests their stuff. We did it all for you to make money. Stop loss levels. We track everything for you. We give you a weekly update. You can duplicate these trades perfectly, and you get a 30-day free trial. Hit the links in the description below. Get on that 30-day free trial. Start making money, because a market procrastinator, which is mean, you procrastinate, you're not making money trading, says the central bank's September decision to lower rates by 0.5 percentage point, a move usually reserved to tackle recession or market crash, was, quote, not necessary, with the economy riding high and the S&P 500 hovering near record. So this is the thing. The Fed always cuts near market highs. That's always how it works. They rarely cut after, hey, the market's down 50%. I think we'll cut now. They always start cutting near the peaks. That's not the issue here. The belief is that we're headed into a recession, so that would necessitate a 50 basis point cut. That's not the case. The Fed is looking at the global economy. They're seeing it slow down. But the experts are saying, look, the Fed didn't need to do that at all. And there's good reasons they did, because the labor market's telling us the market is going to come down. Let's take a look at the NASDAQ 100. You see this in blue against the unemployment rate. And as people hit the unemployment line and get stuck there, well, that in the 90s, that meant market crash. It happened during the dot-com bubble, and once again during the global financial crisis. This time, investors are saying, not a chance. We don't care if the unemployment rate goes up. The Fed's got this. This is going to turn everything around. And you see this big run up in margin expansion as investors are clamoring to buy stocks. But one thing we know is that as workers have less income, that does not lead to higher stock prices. Here you can see total income in the function of average hourly earnings multiplied by average weekly hours of production and non-supervisory employees. When you see a slowdown in that red line, that's a year-on-year rate of change, and you're heading into a recession, well, that means stock market is coming down. Investors want to believe this is going to plateau at a very high rate. We're suggesting it's not. There are a couple times in history. You see here in 2015, 2016. You can see in other times that leads to higher stock prices. This time, we don't think that happens, but Yardeni says they don't need to do anymore. I assume several Fed officials regret doing as much as they did. We're likely to hear that from Fed speakers here in the future. And so what you're seeing is experts are telling the Fed is you didn't need to do 50 basis points, and maybe now you need to back off, because the risk is you're going to unleash inflation. And the critics of the Fed's policy shift, the market has arguably priced in too many rate reductions already. The risk, according to Yardeni, is that additional easing feeds into investor euphoria that will set the stage for a painful market event. So he doesn't think inflation's coming. What he thinks is going to suck everybody in the market when the bubble bursts. They're going to lose a fortune. We already know if unemployment continues to rise, that's going to happen anyways. And any further rate cuts would increase the odds for a 1990-style melt-up scenario, something investors are betting big on for the stock market. In that episode, the S&P 500 lost more than a third of its value from peak to trough, and that could only be the beginning if we see another financial crisis. Now, let's take a look at what the media is saying. So you got the view from the expert that said, hey, the Fed, you went too far. The media is ringing a different bell, saying the Fed is close to pulling off the elusive economic soft landing in 2024 after a great September jobs report. So now you get the view here. The jobs report is telling us that everything is great with the economy. The Fed cut rates into a hot economy as it is. That's going to unleash some inflation, some demand, and that's why you're seeing investors clamor into stocks, despite what Yardeni is saying. And we've been expecting a soft landing. This just gives us more confidence that it seems to remain in place. It also increases the possibility of a no landing as well, meaning even stronger economic data for 2025 than we currently expect. So one payroll report has changed the view of absolutely everybody. Market participants, the experts, the media, everybody's saying this payroll report changed the game. But look at history here as we see the federal funds rate against recessions. What we know, you see 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 maybe if this is it, but 9 times for sure the Fed was cutting into recession. The odds are favorable here. And the Fed has got this wrong. And let's talk about history here. Let's talk about why we're making the same mistakes. But let's first go back to the dot-com bubble, because I want you to see here this emergency meeting on January 3rd. You're going to 50 basis point cut. And then at the regular meeting at the end of January, well, they cut 50 basis points again. And they went all the way down from 6% to 1%. Many people saying there's no way we're getting back to zero. Well, if we go from 6 to 1, we didn't get to 6 this time. We're going back to 0. A lot of people don't think so, but nevertheless, what happened in January is payroll reports printed minus 19,000. This is the non-farm payroll data we're looking at. And then it jumped to 87,000. Well, everything was fine. So the Fed cut a full basis point, 1%. And then it followed an 87,000 print. And then look what happened. In March, April, it just went south and numbers plummeted and the Fed chased the rates all the way down to 1%. But how about the financial crisis? Because it looks like this is happening again. You see the 50 basis point cut. The Fed leads off strong here, and then they back off in October and December and say, well, you know what? Everything turned out okay. We'll just do a couple 25 basis point cuts just to make sure everything's okay. And then they have an emergency meeting in January and drop 75 basis points and go all the way down to 0. Let's take a look at what happened with payrolls. And you can see what was driving this. In July and August, you see minus 30,000, minus 20,000. The Fed reacts, and then look at what payrolls, plus 86, plus 72, plus 116, plus 105. You start to think, wait a minute, there was no need for those cuts. The Fed went too far. And then look what happens after that. Minus 71, minus 70, minus 219, and there goes, of course, the economy right into a financial crisis. And so what we're seeing is the exact same setup as we did going into 2000, a 50 basis point lead-off cut. Everybody then clamoring to come out and say, no, Fed, you goofed up because, look, payrolls turned around. They're likely to listen to that. I'll show you why the Fed's going to get this wrong. But let's take a look at what Goolsbee just had to say, because he welcomes the jobs report and now flags the risk of low inflation. Well, he's got that right. Inflation is not going to be his problem. It's going to be a financial crisis. The rosier job picture is helping to alleviate concern about the labor market and has investors betting on a smaller quarter-point cut at the Fed's next meeting in November. Policymakers will get one more employment report before then, plus, of course, any revisions, along with inflation reports for September. So you can only imagine if the November report turns out any reasonably good number, well, there's going to be a quarter-point cut at best, maybe no cut. Goolsbee said both inflation, which is cool toward the Fed's 2% target, and the employment are in good place right now, and the Fed officials should do what they can to freeze them, suggesting he's probably going to support another cut. It's hard to say what that is. Well, of course, they have no clue what they're doing. There's some evidence of that I think it's definitely higher in my mind than zero, where we were at a lot of years before COVID. What he's referring to is the neutral rate here. And again, they don't know what it is. They actually admit to the fact they have no clue. They just guess. And that's because, well, there is no probable neutral rate. As Fed officials have been increasing their estimate of the longer range neutral rate, the median estimate without adjusting for inflation is now at 2.9%, up from 2.5% right before the pandemic. Again, the rate can only be estimated, not measured, but one thing you can measure is what two-year Treasury yields are saying. And even though yields rose a bit on Friday after the non-farm payroll report, I want you to go back to 2007 here and see two-year yields shown in red against the funds rate. You can see they went down as the Fed initiated a 50 basis point cut and then gingerly did a couple quarter basis point cuts. Meanwhile, two-year yields were telling us financial conditions were tightening. We're heading into a recession that turned out to be a financial crisis. You're seeing the same setup now. The only difference is last time they went to zero, this time people say they're not. My prediction is they're getting to zero again, because what you're about to see is the government is making an absolutely unreal mistake, sending what I believe will be the U.S. economy into a deep financial crisis, one that's going to happen all throughout the world. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.